Hey friends, my name is Sahil and this is my Personal Finance Academy. Of late, I have received a lot of queries from people asking for children's plan. That is, how they can invest for their children's future. Well, it is a very important financial goal for every parent. And it is also very important to plan children's future at an early stage. Considering the fact that an average inflation rate in India is around 5%, an education loan of rupees 10 lakh today would cost somewhere around 25 lakh rupee in the next 15-20 years. And in case you want to send your children for foreign education, it would cost a lot. Hence, it is very important to plan for children's future at an early stage. Now, I did a quick search on children's investment option and I found that the majority of suggestions are insurance cum investment plans. Although, I strongly believe that one should never mix insurance and investment. Then you also have solution-oriented mutual funds for children education. But the mutual fund houses are just packaging these solutions to make them look attractive. Hence, I thought of giving an unbiased and genuine suggestion from my side. So I have divided the investment options for your children's future in 4 different categories. Let's look at each category one by one. First category is fixed saving instruments. As the name suggests, fixed saving instruments give fixed return without any volatility. This option is suitable for those who have a very low risk appetite and are looking for fixed return without any volatility. If you have a girl child and are planning to save money for her education, marriage, etc., you have 2 good options in the fixed saving category. First option is Sukanya Samriddhi Yojana. This is a saving scheme from Government of India, especially for the girl child. The interest rate on this scheme is currently at 7.6% per annum, which is the highest interest rate in savings scheme in India. On top of this, you can also show the investment in Sukanya Samriddhi Yojana under Section 80C to reduce your taxable income up to rupees 1.5 lakh. Not only this, even the interest earned on the investment is completely tax-free. For example, if you invested let's say rupees 10 lakh and your investment value becomes 15 lakh, then you don't need to pay any tax on profit of rupees 5 lakh. So you get 3 benefits. First is highest interest rate, second is reduction in taxable income up to 1.5 lakh, and third is the returns are completely tax free. The only catch is that 7.6% interest is not fixed. It is floating. So Government of India can change this interest rate as per market situation. Next, there is a lock-in period of 8 years. And the daughter should be married. Otherwise, the account will remain active for 21 years from the date of opening or till the marriage of the girl after she turns 18. The minimum investment is rupees 250 and maximum investment is rupees 1.5 lakh in a financial year. Now, second option is sovereign gold bond. Again, this option is more helpful for daughters at the time of their marriage, as gold is an integral part of marriage rituals in India. Normally, people in India like to have some allocation in gold. One of the advantages with gold is liquidity. You can sell it at any point in time. Now, physical gold has its own issues like high making charges, risk of theft, etc. And that's where you have an option of sovereign gold bond, that is government-backed scheme. It is basically a bond, that is a piece of paper. So you don't have to worry about the physical gold. The biggest advantage of sovereign gold bond is that you also get 2.5% annual interest on top of the appreciation in the gold price. For example, if you invest rupees 10 lakh in sovereign gold bond, then you will get rupees 25,000 interest per year, which is over and above the gold price appreciation. The only catch is that there is a lock-in period of 8 years with partial withdrawal allowed after 5 years. By the way, if you hold your investment for 8 years till maturity, you don't need to pay any tax on profit when you sell your sovereign gold bond. Yes, the returns are completely tax-free. Although yearly interest of 2.5% is taxable. But again, a great option to build gold asset for daughter's marriage. In fact, it is also a great option for diversifying your portfolio with some allocation in the gold asset class. Second category is index funds. If you are someone who believes in India's growth story for the next 20-30 years and willing to invest in the Indian economy without worrying too much about the market movement, then index funds are the best options. Index funds basically replicates an index. For example, a Nifty 50 based index fund would invest in top 50 companies of Nifty in terms of market cap and the investment allocation would be exactly the same as the weightage of the stock in the index. For example, if Reliance has 12% weightage in Nifty 50, then out of rupees 100, rupees 12 would be invested in Reliance. Let's say if HDFC Bank has got 8% weightage, then out of rupees 100, rupees 8 would be invested in HDFC Bank. So basically the money is invested in the top 50 companies of India. If you invest in Nifty Next 50 based index fund, then your money would be invested in stocks ranking from 51 to 100 in terms of market cap and in the same exact allocation as per their weightage in the index. You can simply invest a fixed money every month in form of SIP. The reason why I suggest index fund is because they have a very low expense ratio and they are dynamic in nature. It means if a stock is not performing well, then it would automatically get kicked out of the index and the stock doing well will enter into the index. So you don't need to worry about which stock is doing well or not. It will be taken care by the index. For example, recently Z was not doing well, so it was kicked out of Nifty 50 index and Divis got entered into Nifty 50 index. This rebalancing happens periodically. Now, how should you invest in index fund? Well, you have two options. Either invest 50% in Nifty 50 index fund and 50% in Nifty Next 50 index fund. Or alternately, you can opt for Nifty 100 index fund where around 85% of your money would be invested in Nifty 50 and remaining 50% in Nifty Next 50 stocks. Some of the good index funds include your UTI Nifty 50 index fund, UTI Nifty Next 50 index fund, HDFC Nifty 50 index fund, Access Nifty 100 index fund, etc. Alternately, you can also invest in index-based ETFs. Now, third category is mix of index funds and active funds. Index funds are not that popular in India yet, as they sound very boring. Although I'm sure it will gain popularity with time when people will realize that active funds are not able to beat the benchmark. However, if you want some exposure in the mid and small cap category, then you can also consider investing a part of your money in active mutual funds. For example, you can invest in mutual funds like your Parag Parikh Flexi Cap Fund that provides diversification by investing your money across large, mid and small cap categories as well as some exposure in US based stocks. Alternatively, you can also choose individual mid cap and small cap mutual funds like your Mirai Mid Cap Fund, Kotak Small Cap Fund along with US based funds like your Motilal Oswal S&P 500 Index Fund or Motilal Oswal Nasdaq 100 Fund. The best part with equity based mutual fund is that there's only 10% tax on profit above 1 lakh. So you don't need to pay a huge amount of tax on profits. Now the fourth and the most rewarding category is stocks. If you want to invest for your children's bright future, then investment in quality stocks can be a brilliant idea. So let me share some of the potential multi-bagger stocks where you can consider investing periodically. I have tried to balance the portfolio by diversifying across sectors as well as across large, mid and small cap categories. While large cap are the consistent compounders, mid and small cap provides the multi-bagger opportunity. But please note that stocks are very volatile and it demands time and effort to keep a track of stock performance that are part of your portfolio. So you should invest in stocks only when you have the appetite to take volatility in the portfolio and have enough time to keep a track of stock performance. By the way, stocks that I am going to suggest are not the only stocks for investment and this is not a stock tip. You need to do your own research before investing your hard-earned money. If you want to learn more about stock investment and other options like your mutual fund, insurance, etc., you can explore my complete course on money management. You can also explore my investment related services. So first stock is from the online ticketing, catering and tourism sector. It is IRCTC. IRCTC has the monopoly in the railway ticketing and catering business. Over the years, IRCTC has really improved its online ticketing platform as well as now it offers a wide range of catering options including collaborations with QSR chains like Domino's, McD, etc. It also has a monopoly in the drinking water segment within the railway network with the name Railneer. IRCTC has also expanded its product offering into the tourism sector with multiple domestic and international packages. It is also adding a lot of trains in the network. I think that the trend for travel in India would continue to rise and would benefit IRCTC. By the way, I have done in-depth analysis on majority of suggested stocks in my stock fundamental analysis series. I created a video on IRCTC in December 2020 when it was trading at around rupees 1500, and today it is trading at rupees 3200. That's more than double in last 8 months. Next stock is from technology sector. It is CDSL. There are only two depositories in India for Demat account, CDSL and NSDL. So CDSL is the number one company in Demat account in India. Indian economy is bound to grow in the next 20-30 years. And as the awareness towards investment in the Indian economy would grow, it would result in more Demat account openings. Also the fact that now interest rates on FD is just around 5%, which is hardly able to beat the inflation. In the future, this interest rate would even fall further. Hence, more and more people would start investing via stocks and ETFs. This would eventually benefit CDSL. Next set of companies in my list is from the IT sector. It is Mindtree from IT mid-cap sector, Happiest Mind and Newgen Software from IT small-cap sector. We all know how the world is slowly transforming into a digital economy, and that's where the Indian IT companies play a crucial role in the digital transformation. Now you might question why I have not included TCS, Infosys, HCL, etc. in the portfolio. The reason is simple, because I want to focus more towards the mid-cap and small-cap companies that can generate great return in the next 15-20 years. But you can always add TCS, Infosys and HCL. Next set of companies in my list is from banking sector. It includes HDFC Bank and ICICI Bank from large cap category and IDFC First and Federal Bank from mid-cap sector. Although banking sector is going through a rough patch due to COVID-related NPAs, I believe that banks are the backbone of the economy. If you expect the Indian economy to grow, banks would play a crucial role. Next stocks are from the FMCG sector. It is HUL and Tata Consumer. HUL is the largest FMCG company in India with 9 out of 10 households in India using HUL products. No matter what, people would continue to consume the soap, shampoo, toothpaste, cosmetics, food products, etc. Likewise, Tata Consumer is a part of India's biggest corporate house, Tata Group, and has immense growth potential. Next stock is from paint sector. It's Asian Paints. Asian Paints is an undisputed leader in the decorative paint category in India. Today, everyone needs a personalized home and office space, and that's where Asian Paints would play a key role. It has now also forayed into your bath fitting, kitchen solution, and slowly transforming into a complete home decor solution provider. Next stock is from the mutual fund segment. It is CAMS. Again, a recently listed IPO but with huge growth prospects. CAMS is a registrar and transfer agent for mutual fund houses where it provides services like tracking mutual fund transactions like your buy, sell, switch, etc. Then report generation, KYC management, etc. It currently holds around 69% market share in the RTA segment. Again, mutual fund is a highly underpenetrated market in India and would continue to grow. This would fuel the growth of CAMS. Next stock in my list is from small cap piping sector. It is Prince Pipe. Piping sector in India is expected to grow at a CAGR of 12 to 14% as the Indian government has a lot of focus on solving the problem of sanitization and water supply in the rural part of the country. And that's where your UPVC and CPVC pipes will replace the entire metal infrastructure in the country. UPVC and CPVC pipes are lightweight and highly durable, and they don't get corroded like your metal pipes. And this would benefit companies like Prince Pipe. Next stock is from auto ancillary sector. It is Endurance Technology. Endurance manufactures the suspension, transmission, braking system, etc. for your two-wheeler, three-wheeler and four-wheeler. Although the auto industry is struggling for some time, in the long term, there will be growing demand for two-wheelers and four-wheelers. Endurance will also benefit from the electric vehicle adoption all over the world. Next set of stocks are from the chemical sector. It includes your Deepak Nitrite, Alkyl Amine, Galaxy Surfactant and PI Industries. Chemical sector in India is bound to grow on account of China Plus One theme and focus of Indian government on Atmanirbhar Bharat, where they want to reduce dependency from China. Next set of stocks are from software and research industry. It is Tata Elxsi and L&T Technology Service. Both companies are doing amazing work in the area of engineering and research. For example, both are working in mobility space and partnered with OEMs for your connected, safe, electric and autonomous vehicles. Both are working with OTT players in creating personalized, secure and delightful customer experience and many more innovative solutions. Next stocks are from the pharma sector. It includes Divis Lab and Laurus Lab. The demand for pharma sector would continue to increase due to rising lifestyle diseases, and there's a strong focus on API manufacturing in India to reduce dependency from China. Divis Lab is the leader in API manufacturing, and Laurus Lab is a mid-cap pharma company that would become a large-cap company in the future. Final stock is from FMEG and cables and wires sectors. It is Polycab. Friends, infrastructure is a huge theme in India, and you need cables and wires to set up the digital infrastructure as well as for electricity purpose. On top of that, you would need fan, lights, cooler, geyser, etc. And that's where Polycab can generate multi-bagger returns. So basically, you have 4 different options. Number 1 is fixed saving instrument, second is index fund, third is mix of index and active fund, and fourth option is stocks. Now you need to decide how you want to invest, and this decision would depend upon your risk appetite. You can either opt for any of the 4 suggested options, or you can make a combination of all. For example, you can have 25% in fixed saving, 25% in index, 25% in active fund, and 25% in stock. Or you can simply invest 50% in stock and 50% in mutual fund, with 25% in index fund and 25% in active funds. Now tell me in the comments, which is your preferred option for children planning, and how are you allocating your money for your children's future? By the way, my website detail is in the description box. I will see you in another video. Till then, take care.